Somewhere in America, right now, someone is opening a letter from their health insurance company. It says one word: denied. They don't know it yet, but the odds that letter exists at all depended less on how sick they are and more on which logo is printed at the top of their insurance card, which state they live in, and in a growing number of cases, whether a human ever actually looked at their file at all. Some companies deny 6 out of 100 claims. Others deny 33 out of 100. Same country, same laws, same basic coverage requirements. By the end of this video, you're going to know exactly where your insurer ranks, why the gap is this big, and something most people watching this have never heard about: the machines that are quietly making these decisions before a human ever gets involved.
Here's the number that should bother everyone watching this, no matter who you're insured with. Roughly 1 in 5 health insurance claims submitted through the ACA marketplace get denied. Not because the treatment wasn't covered, not because it wasn't needed, just denied. And here's the part almost nobody knows. Most people don't fight back. The vast majority of denied claims are never appealed. People just pay the bill, or skip the treatment, or quietly decide they can't afford to get better. Which means insurers denying more claims isn't just a policy stat. It's a strategy that quietly works because most of us don't push back. So the real question isn't, does my insurance deny claims? Every insurer does. The real question is, how much more likely is your specific company to say no compared to the one down the street? And once you know that, does it change how you'd fight back? That's what we're mapping today.
Let's start at the top of the list. The companies most likely to tell you no. Oscar Health, roughly 1 in 4 claims denied. One of the highest denial rates of any national insurer offering broad multi-state coverage. United Healthcare, among the highest denial rates of any major US insurer, alongside a smaller insurer called AvMed. Both landed at roughly a third of all claims denied in recent data. Read that again, a third. Now, before you assume this is just a big evil company story, it's more complicated than that, and more interesting. The type of plan you're on matters just as much as the company you're with.
Employer-sponsored plans tend to have some of the lowest denial rates, partly because employers are shopping around every year and won't renew a plan that generates constant complaints from staff. ACA marketplace plans, the ones people buy individually, see meaningfully higher denial rates on average. And Medicare Advantage, the private alternative to traditional Medicare that covers tens of millions of older Americans, has become one of the most scrutinized categories in the entire industry, which we're coming back to in a few minutes.
Now, here's where it gets interesting, because denial rates aren't just about the company or the plan type. They're about where you live. 2 states stood out with the highest overall denial rates in the country: Hawaii and Alaska, both over 25%. Meanwhile, South Dakota sat at roughly 5%. Same insurance system, same federal marketplace. A 5 times difference depending on your zip code. Why would geography matter this much? Partly, it's about how many insurers compete in a state. Fewer competitors means less pressure to approve claims to keep customers happy. Partly, it's provider network size. Rural states with fewer in-network specialists generate more out-of-network denials by default. It's not random, it's structural.
Now, let's flip to the other end of the list, the companies that actually pay out. Kaiser Permanente, around 6% denial rate, consistently the lowest among national insurers. Why? Kaiser isn't just an insurer. It also owns and runs its own hospitals and clinics. When the people approving your claim and the people treating you work for the same organization, there's a lot less financial incentive to say no. Sit with that for a second. The lowest denial rate in the country belongs to the one company that isn't just an insurance middleman. That's not a coincidence. That's a structure. And structure is exactly what we're getting into next. Because the newest layer of this story isn't a person making these decisions at all.
Here's something most people have no idea is happening to their own claims. A growing share of denials aren't being decided by a doctor at all. They're being decided by an algorithm. The most well-documented case involves a tool called NH Predict, used in Medicare Advantage plans to help decide how much rehab or post-acute care a patient should get. after things like a stroke or a major surgery. Multiple lawsuits allege the tool was used to issue blanket denials, cutting off care on a predicted timeline, regardless of what a patient's own doctor recommended. Here's the number that should stop you in your seat. In one of these cases, it's alleged that roughly 90% of denials issued using this kind of algorithmic review were later overturned on appeal. 90%.
Think about what that actually means. If 9 out of 10 denials get reversed once a human actually looks closely, the algorithm wasn't finding people who didn't deserve care. It was denying almost everyone, and betting that most people wouldn't have the time, energy, or knowledge to appeal. This isn't a fringe theory. Courts have allowed lawsuits over this exact practice to move forward, specifically examining whether insurers broke their own contractual promises that coverage decisions would be made by clinical staff, not software. And it's serious enough that new rules now explicitly require a qualified healthcare professional to review any Medicare Advantage denial before it reaches a patient. And some states have passed laws banning algorithms from making medical necessity decisions on their own.
So why would a company build a system like this in the first place? Industry research has estimated that AI tools could automate somewhere between half and 3/4 of the manual work involved in reviewing claims. That's a real efficiency gain. Fewer staff hours, faster turnaround. But efficiency and accuracy aren't the same thing. And when the system's version of efficient means auto-denying first and only correcting the mistake if someone fights back, that's not a technical glitch, that's a design choice. Which brings us back to the question from the title of this video.
Here's the uncomfortable truth. Most denials aren't a person reading your file and deciding you don't deserve care. Roughly 77% of denials get filed under all other reasons, a category so vague that insurers aren't required to explain it in any real detail. Break down what we do know. A big chunk of denials come from missing prior authorization, a form that wasn't filed, not a treatment that wasn't needed. Another chunk comes from excluded service classifications, a technicality buried in the plan's fine print. And now a growing and harder to see chunk comes from algorithmic pre-screening. Only a small slice are genuine medical necessity disputes, where a doctor at the insurance company actually disagrees with your doctor. So is it on purpose? The data can't prove intent, and we're not going to pretend it does. What it can prove is that some companies have built systems, paperwork requirements, pre-authorization hurdles, vague denial codes, and now automated review tools that produce dramatically more denials than their competitors, year after year, plan after plan. Whether that's a side effect of chasing efficiency or the actual point of the design, the pattern speaks for itself. And patterns, unlike intentions, are something we can actually measure.
Here's the statistic that should genuinely make you angry. When people do appeal a denied claim, a huge share of those appeals actually succeed or get partially overturned. Internal appeals, where the insurer reviews its own decision, overturn roughly 4 in 10 denials. Kick it up to an external review, where an independent third party outside the insurance company makes the call, and success rates climb even higher. Especially for Medicare Advantage appeals specifically, where they're reported to run around 75%, 3 out of 4. But almost nobody does it. Less than 1% of denied claims on the federal marketplace ever get appealed. Insurers aren't just betting that they can deny your claim. They're betting that you won't fight it. And statistically, they're right. That's the real gap in this system. Not just the denial rate, the silence afterward. So, where does your insurer land? If you're with one of the companies near the top of this list, that denial letter you got last year, it might not have been about you at all. It might have just been the math or the model. This channel isn't here to tell you what to do about it. No advice, just the data mapped out.
But now you know what the data actually says, and you know that the odds of winning an appeal are a lot better than the 1% of people who ever try one. If this kind of thing makes you want to know more about where you live, what plan you're on, and what it's quietly costing you, that's what this channel is for. New data set every week. So hit the subscribe button, like the video, and see you in the next video.